Are kicking off chapter 4 with talking about journalizing and posting transactions. So we will look at the flow of our information from the beginning, which is the source documents, all the way through the trial balance. So allow yourself a lot of time to absorb this because this is a pretty meaty chapter. So we're going to start with our source documents, and we're going to analyze these to determine what this transaction really is. And so we're going to look at our source documents. A source document could be an invoice, it could be somebody's time card, it could be a check that we're writing. And then we're going to look at that source document, look at our chart of accounts, and figure out which accounts on our chart of accounts are impacted by this source document. And so we will then enter the transaction in the general journal, which is journalizing, and then it will get posted to the general ledger. And then from there, we're going to have what's called a trial balance. Don't worry, you don't have to have gotten all of this at this point because we will continue to go over this. So again, purpose of source documents is this is our evidence. This is what's telling us what this transaction was all about, and we're going to want to make sure that we retain these records to back up these transactions that we create from these. And as I said before, they could be checks, they could be receipts or statements, or again, even an employee's time card would be considered a source document when you get ready to prepare your payroll. And then, as I said before, we then take this source document and we look at our chart of accounts and we try and basically translate this source document into accounting ease by figuring out which accounts are impacted by this transaction. And so our chart of accounts is every account that the company uses, and it's going to be we'll have little numbers next to them as well. And based on the numbers, they will be classified in a way that like accounts appear with similar numbers. So, you'll have your assets, which will be together in the way that they are sequentially numbered. So here's an example, and assets begin with 1. So 1 to 199 are assets for Rohan's campus delivery chart of accounts. Again, all of these, cash, accounts receivable, supplies, our insurance, our equipment, these are all things that we're going to use to generate money for our company. These are our, kind of our tools of the trade and our resources. Now, we're going to start. Liabilities begin with a 2. And then we go to owner's equity, which starts with a 3. Revenues beginning with 4. And so what's left? We've got our assets, our liabilities, our owner's equity, and under the umbrella of owner's equity, that includes our capital account, the draw, the revenues, and the expenses. And so as you see, there we go. The expenses begin with, they're numbered in the 5 sequence. And so now we've got our source document, we've looked at our chart of accounts, and we've said, okay, this transaction involves these particular accounts. Now we're going to journalize them. Fancy way to say enter them. And so what is a journal? A journal is going to be our day-to-day list of what happens in transactions. and it will give us a record as to every financial related transaction that we've done in chronological order. And so now we've got an investment by Rohan. We're going to assume that this is day one of our brand new business. And we've got Rohan investing $2,000 in the business on June 1. And so this is going to be a new transaction, June 1. And so, and I guess before I jumped forward, I should have said, okay, what accounts does Rohan's investment implicate? Well, he's investing $2,000, and that's money, otherwise known as cash. So cash is certainly involved. And his initial investment, that's his capital, his equity. And so we've got our max in capital and cash. Remembering, of course, that a debit entry increases our cash. So because we're getting cash and the capital is increased contemporaneously with the infusion of cash, we can see how we're going to now journalize these transactions. So setting these up in T accounts just gives us a good visual representation of what we're going to put in our journal entry, which we are now going to do. So step one, we enter the date. Then we're obviously going to have the account listed in the description. And we want to always list our debits first. So for a particular transaction, you can, as we get further into this, you will have potentially multiple debits and multiple credits involved in one single transaction. So for that transaction, all your debits are going to be listed first, then all of your credits. And I guess I should also say, your debit, when you do your journal, is going to be flush with the left margin. And why do I care? You'll see in just a second. So we've got our debit of $2,000. Now we've got our credit. And notice the indent that you see here. So the credit entries are going to be indented from the left margin. And then we've listed our credit for Rohan Capital in the credit column. And we see our debits and our credits equal, so we're all good. Then we're going to just do a little description. And it may seem pretty obvious on its face what these things are, but over time, when we might have lots of transactions that are of similar nature, it's good to have this little explanation, a few words, just to trigger somebody's memory when they're going back later to say, wonder what this was. You know, it's particularly helpful, for example, if we've got a vendor that we're buying lots of equipment from, if we put specifically what tool or piece of equipment that is, it might help if we have to go back and trace some things later rather than just the account information. So now when we're all good here, and now we're going to look at our second transaction. But before we do that, we're going to make sure that we skip a line between our transactions. So when you're doing your homework, please make sure that and I think that your homework will do this for you already, but if not, just make sure that your debits are indented from where the cash, or excuse me, from where your credits are indented from where the debits would be. Then your explanation, your description is indented from where the credits are. And then you're going to skip your line, and you will then go on to the next transaction. And so, as I had said previously, you might have entries where you have multiple credits and or multiple debits. And so, as I explained, you're always going to list all your debits before you've got any credits. And so we've got an example of this to illustrate. we've got June 25th. Rohan purchases a $1,500 scooter for $300 in cash and $1,200 on account. So what are we looking at when we think of accounts for this? Well, so we've got scooter, cash. Those both sound like assets to me. On account, sounds like we're going to owe somebody for that. So it sounds like a liability. So let's see, we're getting a scooter and we're losing some cash. And then we're gaining a liability. So we've got our two asset accounts. We've got our cash, and the scooter is considered delivery equipment. And our liability account, which is our accounts payable for the money we're going to owe. And so as they say, each account are they increased or decreased as a result? Well, we didn't have a scooter yesterday. Now we have one. So I think we increased the number of scooters we have for a total of $1,500. Before we bought the scooter, we had $300 in cash. Now we don't. So we have less cash. Our cash decreased by $300. And we didn't have this debt before we bought the scooter. So now we have more debt, more liabilities. So that increased by $1,200. Let's see if I'm right. Lo and behold, yes, in fact, we increased our delivery equipment by $1,500. Our cash was decreased by $300, so that goes on the credit side. And our accounts payable increased by the $1,200. And since, unlike with assets, a credit will increase a liability, so the increase shows up on the credit side for our accounts payable. And now we'll just, there we go. We'll look at all of these together and see that in fact, so we've got one debit for $1,500 and two credits totaling $1,500. So we know that we are in balance. Now we're going to journalize these transactions. So in terms of the order of these items, we've got multiple credits here. And so does it matter that we put accounts payable first or cash? No. It does matter, though, that we made sure that we listed our debit before we began to list any credits. And so note that we're flush with the left margin on the debit line, and then both of our credits are indented, and yet an additional indent on our description. Stop here, and we will pick up next time on Objective 5.